What if the only thing missing in your trading was a concept so simple, so easy to understand that it can be taught in less than a 10-minute video? Welcome to the trading channel. If you are new, make sure you click that subscribe button and the notification bell down below the video to be alerted when we come out with new educational content about Forex each and every week. If you're a returning subscriber, welcome back. Make sure you click that like button for me while the intro and disclaimer roll. And when we get back, we'll talk about this one simple concept that causes most traders to fail that you're going to learn in less than 10 minutes. Before we get into this concept that we're going to be talking about today, I'm going to take you through a couple of different currency pairs that we were looking at earlier in the week, show you guys how that analysis has played out, and also what we're looking for now based on the way those markets have moved since our analysis earlier this week. On the pound dollar, earlier in the week we talked about this pair coming down into a major level of support. We said it was likely that this pair would hit around the 127 even handle number, and let me play a clip of that really quick. It's going to be a very short clip. I'll be right back. Here on this pair, we are in a period of consolidation. As you can see, the market's not in any type of clear trend, so that discounts having a bias on a lower time frame. So right now, we can't say whether we have a short bias or a long bias based on the analysis that I personally use, the technical analysis I personally use when trading. Right now, all I can trade personally is support and resistance levels, major support and resistance levels like the one that the pound dollar is on its way down to. Seemingly, we're going to hit 1.2698. If we do, for me personally, this is going to be a good place to look for some possible counter trend bounce up to the next major level of structure, being at 1.2803. So this is a possible area where I'll be looking to get a possible around 100 pip bounce out of this market for a counter trend play here on the pound dollar. Okay, so as you saw in that clip, we were expecting this market to come down into the 1.27 area, and we were expecting about 100 pip bounce out of the market after touching that area. What's happened so far on the pound dollar? Let's go ahead and zoom down to a smaller time frame. Currently, we have gotten no reason for entry here on this currency pair when it comes to being in this zone, because that's what it takes to create a strategy, create a trading plan. We're not just entering randomly at significant levels of structure. We're actually waiting for entry reasons, waiting for specific strategies to come together at these specific levels. Here we are on the hourly chart, and let's actually check since hitting the 127 area. Go ahead and grab our ruler tool. This market has pushed up 50 pips, about half of what we expected. So what does that mean? Well, that means that based on the analysis we've done through historical data and the analysis we've done in the past, based on that, we could see a higher bounce out of this market. We could see the pound dollar do something like this, or even better situation that we're actually waiting for here at the trading channel is a retest of this 127 level, and it's very specific entry reason right here at this level to go long in anticipation for the rest of that 100 pip move. So what are we looking at now here on the pound dollar? We're actually just waiting on a double bottom at this very specific level of structure that we pointed out earlier in the week based on major support looking out on the daily charts. Let's check that daily chart once more to show you guys what I'm talking about. This level of support, you can see, has pushed the market up multiple times in the past, coming down into that level once more. I don't know that it's going to necessarily create a big uptrend like it has these previous two times, and I'll show you guys why that's the case, why that's my belief as well. As you can see, the first time we bounced off 127, the market jumped up a significant amount. The second time, we jumped up a little bit less. This time, we could quite possibly jump up a little bit less, maybe come up to this trend line before pushing down. But what I do know is that this level should give some type of bounce, and we've already got a 50 pip bounce out of this level. But what I would really expect from this level is something around 100 pips of a bounce, maybe even a bounce up to the 128 level at around that 100 pip mark, and that's exactly what we're expecting. So based on what we're expecting, based on that predictive analysis, we're going to be waiting for a double bottom on a lower time frame there on the pound dollar. Now, another pair that we were taking a look at that has done something interesting is the Aussie dollar. On the Aussie dollar, we were saying earlier in the week that we wanted to see a close above this previous level of resistance. That's exactly what we got. We'll go down to a smaller time frame to show you guys what we're waiting on now. Let's drop down to let's say a 4-hour chart. On this 4-hour chart, the red area we have highlighted here is going to be that very specific zone of structure, that likely area for great trading opportunities. So we're waiting on the Aussie dollar to get into that area and provide some type of entry reason to go long based on our structure analysis and our trend analysis out on higher time frames, the daily chart. So that's what we're expecting out of these two currency pairs. Now let's get into the real subject matter of today's video. The real subject matter of today's video is a concept that's extremely simple, yet 99% of traders do not understand it or implement it into their trading, and that causes most traders to either blow their account or completely stop trading. What is this concept? This concept is risk management. And risk management consists of about 3 major parts. What are these 3 parts? Well, it starts with risk capital. Then risk per trade, and overall exposure is the third. These 3 concepts are going to play a major part in your trading and will play a major part in your trading success. Let me explain a little bit about why. You see, most traders that fail start out and do something like this. Let's say you start trading because you anticipate creating massive wealth from trading from the beginning. You just anticipate that you're going to put money in the market, and that money is going to multiply over and over and over every time you place a trade. And then you put money in the market, and that doesn't happen. Now, the first problem, what was the first step in risk management? Risk capital. This is the first problem that I see quite often. Most people don't understand risk capital or their own personal risk tolerance to the point that they understand the amount of capital they should risk in any financial market when they trade. So what is risk capital? Let's define it first. Risk capital is an amount of money that you are more than willing to risk and possibly lose in financial markets for this specific scenario in the Forex market, and that if lost, this amount of money would not substantially affect your financial situation. You're not using the money you need for your rent next month to trade with. That's what that means, right? And what you have to do in order to understand risk capital is really sit and think about what is an amount of money you're willing to risk trading. Remember, we're in a career where there's like a 90% fail rate. So it's quite likely that you will lose some or all of your initial investment whenever you first start trading, especially as a beginner, and especially without understanding the concepts of risk management. So we have a new trader, he starts trading, right? Let's say he allocated 100% of his net worth. He allocated every bit of his savings account to trading. Now he jumps in the market. He expects to win every trade. He trades 10 different trades because he saw a very nice looking strategy on YouTube somewhere. So he takes the next 10 trades he sees based on what he thinks that strategy is. He loses 6 of them. He doesn't understand risk management and risk capital. He's risking a little bit more than he should per trade. He loses 60% of his total account value. That trader is almost done with trading in only 10 trades. Because of this concept of not understanding risk capital, he's lost 60% of his net worth in 10 trades. That is something you want to avoid at all costs. So first step to understanding and implementing risk management into your trading, something that's massively important and that can keep you from being the 90% of traders that fail, is understanding risk capital and only allocating an amount of money that you are comfortable if lost to trading. Because again, guys, we're in a career where there's a 90% fail rate, especially when you first start out. There's a pretty likely chance you'll lose some or all of your initial investment. So keep that in mind when starting a trading account. That's the first step of risk management. Let's move on to step number 2, risk per trade. Step number 2 is risk per trade. Let's go back to the same example. A trader that takes 10 trades, right? He takes 10 trades and loses, let's say 6 out of the 10, and loses 60% of his total account value based on that. Because maybe he was risking 10, 12% of his total account every single time he placed a trade. Now, this is how a lot of traders start. Most traders, when they begin in a trading career, are there not to protect their account, not to manage risk. Most traders go into it trying to make as much money as possible. And while wealth can be created from trading and making as much money as possible is important, but as much money as possible has to come with the correct risk management. Otherwise, you will never last in this game. You have to start your account with an appropriate amount based on your risk tolerance. That's risk capital. After that, you have to be risking a very small percentage of that account per trade, and that has to be something you're comfortable with as well. Take the same trader, for example, or actually let's do a new example. Let's take a strategy that's about 60% accurate and based on the strategy has a series of 5 losses in a row. So in that exact position, with 5 losses in a row. Let's say that's the maximum drawdown, is those 5 losses in a row for this specific strategy. What if you were risking 5% of your total account value every single trade? Those 5 losses in a row would create a 25% drawdown. Now you have to ask yourself, are you comfortable losing 25% of your total account? Or do you need to risk less? A lot of times the number is thrown around that 2% of your total account value is the maximum amount you should ever risk on a trade. While I would agree that that is the maximum amount you should risk, I think that 2% is way too high for someone who is just starting out. And I am in no way telling you what you should risk. I'm not a financial advisor. Make sure to do your own due diligence whenever it comes to figuring out your own risk tolerance and what an acceptable amount for you to risk per trade actually is, and what an acceptable amount of risk capital is for you. But when it comes to risk per trade, you need to think about it in terms of drawdown and not in terms of your potential return on investment. I made this mistake earlier in my trading career. I would look at a strategy and I would look at the ROI and go, oh my gosh, I could use this strategy for the next 12 months and make 1,000% in 12 months. And what I wasn't paying attention to is that little section on my spreadsheet that said drawdown. You see, over the next 12 months, I could make 1,000%. It's possible. But can my emotions handle the 45, 55% drawdown that comes with? Imagine starting an account with, let's say, $10,000, and within the first 6 months, you're down $5,000. I've had a drawdown last a very long time. I haven't had one last 6 months. Let's go 3 months, because I have had drawdowns last 3 months. So let's say in the first 3 months with this $10,000 account, you're risking way more than you should per trade, and you have a 50% drawdown in 3 months. How likely are you to continue trading that strategy, trading based on the rules that you use, to continue staying disciplined after losing 50% of your total account value? Pretty unlikely, right? I would have to agree. So the way to figure out your risk per trade, this comes with a lot of work. You have to create your rules-based strategy, backtest that strategy through historical data, see the expected ROI and drawdown of that strategy, and adjust your risk per position until that drawdown number hits a number that you're actually comfortable with. And that's something you'll have to do on your own, but that is the second step to risk management, which is risk per trade. Now, the third step to risk management is overall exposure. Overall exposure, for me personally, the way I manage risk and the way I trade is with a risk per position. Some people do it based on a lot size. That's not the way I manage risk. I manage risk through risk per position. So for me, overall exposure is the amount of trades I can be in at once. And it is percentage based. So personally, I don't like having more than 6% of my total account ever exposed in the market at once, right? I don't want to be in more than 3 trades at a time if I'm risking 2% per trade, 6 trades at a time if I'm risking 1% per trade. I don't want to ever risk more than 6% of my total account value at any one given time based on the amount of trades I'm in and based on my risk per position. So that is an overview of maximum exposure, another number you need to sit and think hard about before you implement it into your risk management plan. So guys, as you can see, those are the steps that create a positive risk management plan, a risk management plan that can help you create trading success. And the question you have to ask yourself is, have you actually done this for yourself? If not, it could be a massive reason that you're struggling to create trading success. As a special thank you to you for being a part of the community here at the Trading Channel, and also for making it the end of this video, I'm actually going to do something really special. You see, in order to create a proper risk management plan, you have to have a spreadsheet capable of making the necessary calculations in order to calculate your winning percentage and to calculate your maximum drawdown. That is essential when it comes to the process of creating a risk management plan. Doing all of that manually would take a massive amount of time. So in order to help you shave that time off, and again, as a special thanks for making it at the end of this video and for being a part of the community here at the Trading Channel, what I'm going to do is over the next few days only, this is a very limited opportunity, I'm going to give you my spreadsheet that I use personally, and you can see it on the screen in front of you now, that is capable of making these calculations for absolutely free. You can find that link in the description labeled free spreadsheet. So go ahead and click that, and I'll see you guys over on the spreadsheet mastery course, which is a full training we do on how to build a spreadsheet. And again, along with that, you'll have the opportunity to actually download the spreadsheet itself as well for free, only for the next few days though. So go ahead and click the link in the description. Also, if you enjoyed today's video, as always, make sure you click that like button for me. If you are new here and you haven't subscribed yet, go ahead and click the subscribe button and the notification bell. Share this video with anyone who needs help when it comes to the risk management section of their trading, which I would imagine is a few traders that you know. So make sure to share this video as well, and I will talk to you guys in the next one.